When you start a business, one of the most important decisions you'll make is how to protect your personal assets from business liability. Transferring personal assets to a limited liability company, or LLC, is a common strategy that can shield your property while supporting your business operations. Understanding how this process works can save you from costly mistakes and unexpected tax consequences. Transferring personal assets to an LLC means moving ownership of property you personally own into the name of your business entity. This creates a legal separation between you as an individual and your business. The primary benefit is liability protection. If your business faces a lawsuit or debt, your personal assets held within the LLC structure gain an additional layer of protection. Beyond protection, this transfer helps organize your business finances and may offer tax advantages depending on how the transfer is structured. Several types of assets are commonly transferred to LLCs. Real estate is perhaps the most frequent, including rental properties, office buildings, or land used for business purposes. Vehicles that serve business functions, such as delivery trucks or company cars, are also regularly transferred. Business equipment like machinery, furniture, and office technology often moves into LLC ownership. Intellectual property, including trademarks, copyrights, and patents, can be transferred to protect these valuable assets. Finally, cash or investment accounts may be contributed to provide operating capital for the business. There are three primary methods for transferring assets to an LLC, each with distinct legal and tax implications. The first method is contribution. You contribute personal property as a capital investment in the LLC. This approach is common when starting a business and typically does not trigger immediate tax consequences. The second method is a sale. You sell the asset to the LLC at fair market value. If the asset has appreciated in value since you acquired it, this sale might generate a taxable capital gain. The third method is leasing. The LLC leases the asset from you while you retain personal ownership. This can provide tax deductions for the LLC while allowing you to maintain control of the asset. Proper documentation is absolutely essential for a legally valid transfer. Without it, the IRS may treat the transaction as a taxable event, or the transfer may not hold up in court if challenged. For any asset transfer, you should draft a bill of sale that clearly states the asset being transferred, its value, and the terms of the transfer. For real estate, you must record a new deed with the county recorder's office, showing the LLC as the new owner. For vehicles and other titled assets, you need to update the title and registration with the Department of Motor Vehicles or relevant authority. You should also amend your LLC's operating agreement to reflect the asset contribution and adjust member capital accounts accordingly. Finally, notify your insurance company and any creditors to ensure liability coverage reflects the new ownership structure and update related financial agreements. If the asset you're transferring carries a mortgage or lien, the process becomes more complicated. Most lenders include a due-on-sale clause in their loan agreements. This clause can trigger the full loan balance to become immediately due when ownership transfers, even if you're transferring to your own LLC. You have several options to handle this situation. You can refinance the loan in the LLC's name if the business qualifies for financing. You can request written consent from the lender to assume the debt under the LLC. Or you can continue making payments personally while maintaining clear records that distinguish personal and business finances. Failing to address mortgage issues properly can result in loan default or unintended tax consequences. So consulting with a real estate attorney or business lawyer is strongly recommended. The IRS pays close attention to asset transfers, and failing to report them correctly can create significant problems. Even if no money changes hands, the IRS may treat the transaction as a sale at fair market value if documentation is inadequate. To stay compliant, assign a reasonable fair market value to each asset based on current market conditions. If you're changing how your LLC is classified for tax purposes, you may need to file IRS Form 8832. Ensure that Schedule K-1 reflects each member's updated capital contribution. Be aware of potential capital gains taxes or recapture of depreciation if you've previously claimed depreciation deductions on the asset. These tax issues can be complex, particularly for assets that have appreciated significantly in value. Working with a tax professional helps ensure you understand the full tax impact before completing the transfer. One benefit of transferring income-producing property to an LLC is the ability to claim depreciation. Depreciation is a tax deduction that accounts for the wear and tear on an asset over time. IRS regulations permit LLCs to depreciate property over the period considered to be the asset's useful life. For example, residential rental property can typically be depreciated over 27.5 years. This depreciation reduces the taxable income generated by the property, lowering your overall tax burden. However, if the LLC later sells the property, you may face depreciation recapture, which means paying tax on the depreciation deductions you previously claimed. Transferring real estate to an LLC can sometimes trigger a property tax reassessment by your county assessor's office. A reassessment could result in a higher assessed value and increased property taxes. Whether this happens depends on your state and local laws. Some jurisdictions treat transfers to single-member LLCs differently than transfers to multi-member LLCs. Before completing a real estate transfer, contact your county clerk or assessor's office to ask whether the transfer will trigger a reassessment. This simple step can help you avoid an unexpected increase in your property tax bill. While transferring assets to an LLC offers many benefits, it's not always the right choice. You should generally avoid transferring your primary residence to an LLC. Doing so can complicate your ability to claim the mortgage interest deduction and may eliminate homestead exemptions that protect your home from creditors. Assets with purely sentimental or non-business value typically don't benefit from LLC ownership and may create unnecessary complexity. Highly leveraged assets can also be problematic if your LLC lacks the creditworthiness to assume the associated debt. Additionally, some states impose transfer taxes or other penalties when property changes hands, even between you and your own business entity. Always weigh the costs against the benefits before proceeding. Transferring personal assets to an LLC is a powerful tool for protecting your property and organizing your business, but it requires careful planning and proper execution. The process involves choosing the right transfer method, preparing thorough documentation, addressing mortgage and debt issues, and understanding the tax implications. Mistakes can result in unexpected tax bills, legal disputes, or loss of liability protection. Working with an experienced attorney or accountant ensures you comply with state laws and IRS requirements while maximizing the benefits of the transfer. Taking the time to do it right from the start protects both your personal assets and your business's future.